Is Platinum Group Metals, PLG, basically a lottery ticket on a genuinely world-class mineral deposit, maybe one of the last really massive palladium discoveries left on Earth?
Or is it just a super high-stakes gamble,
Mm.
an all-or-nothing bet facing these huge financial and geopolitical hurdles, especially in South Africa's, well, let's face it, incredibly complex mining scene?
Exactly. Today we're diving deep into all of it, trying to help you frame the key questions you need to answer that for yourself. Welcome to the deep dive. Today we're doing a custom deep dive into Platinum Group Metals Ltd. It trades on the NYSE American Exchange, ticker symbol PLG.
Yeah.
And this deep dive, it's built from a pretty comprehensive stack of articles and research, so we're aiming to give you the full picture, the nuances, everything.
Yeah, and right off the bat, I think it's absolutely critical for you to understand PLG isn't your typical company, not by a long shot.
Right.
You won't see them making products or, generating revenue like a normal business. It's a development stage mining company.
Okay.
That means its value, its whole reason for being, really, is almost entirely based on the future potential of its main asset.
Yeah.
That distinction is fundamental. It colors everything else.
Good point. And just for context, our analysis is current as of June 29, 2025. The stock closed that day at $1.48 per share. So with that crucial understanding, that unique nature of PLG, let's really dig in. We're opening with Chapter 1, Business Understanding. So how does a company with, like you just said, basically zero revenue streams, how does it even operate, let alone chase a multi-billion-dollar project?
Well, their core activity is pretty singular. It's all about advancing their main asset, the Waterberg Project, pushing it towards development and eventually construction.
Okay.
Think of it like this. They spend money, a lot of money,
Yeah.
but they don't actually make any yet from, their core operations.
Right.
So they completely rely on external capital. They raise money mainly by selling off pieces of ownership, using things like at-the-market equity programs, private
So
placement.
selling shares.
Selling shares, exactly. Their business, in essence, is convincing the capital markets, convincing investors to fund that future value. It's this constant necessary cycle of raising cash, which, means ongoing dilution for shareholders.
Okay, so what are these valuable future products? The stuff actually buried deep in the ground that they're banking everything on.
So the Waterberg deposit is primarily rich in what the industry calls the 4E platinum group metals. That's palladium, PD, platinum, PT, rhodium, RH, and gold A.
The 4 E's. Got it.
But let's be clear, palladium and platinum, those are the real economic backbone here. Their value is just intrinsically tied to their main use.
Yeah.
Automotive catalytic converters, the things that cut down harmful emissions. So the long-term future of the global car industry, and importantly, what kind of cars we drive, that directly impacts PLG's potential. Big time.
Makes sense. Now, at a market cap of around $155 million, PLG definitely looks like a small fish. But that number alone, it doesn't really capture their market position, does it?
No, not at all. Their position isn't about their current size. It's entirely about the potential scale of Waterberg.
Yeah.
If they can get it financed, get it built.
Yeah.
It's positioned to be a large-scale, low-cost producer of palladium and platinum. Imagine holding the key to this potentially massive vault, but you need literally billions in funding to build the door to get inside. That's kind of PLG right now.
Okay, that's a good analogy. So what's their primary value proposition then? What's the real hook for an investor beyond just, hey, there's metal in the ground?
It really comes down to the Waterberg Project's geology. It's exceptional. It's large, it's relatively shallow, and it's incredibly continuous as an ore body.
Okay.
And that specific geology, it allows for highly mechanized, automated mining methods. That translates directly into lower labor needs and, crucially, theoretically, much cheaper production costs.
Cheaper to get it out of the ground.
Exactly. The whole proposition is becoming one of the world's absolute lowest cost producers. That means they could theoretically still make money even when PGM prices dip, giving them a big advantage over older, higher cost mines.
Okay, so their fate is obviously tied super tightly to the PGM market. What are the big trends, the headwinds and tailwinds that people need to be aware of?
Well, demand, especially for palladium, is just overwhelmingly dominated by catalytic converters. Like 80% of consumption goes there.
Wow, 80%.
Yeah. Now, what's interesting is the platinum market itself, it's actually in what they call a structural supply deficit, and that's forecast to continue for a third year in 2025. We're talking a deficit of maybe 966,000 ounces.
So not enough platinum being produced.
Basically, yeah, which points to a tightening supply,
Yeah.
potentially supporting platinum prices. Now, long term, The biggest threat, no question, is the global shift to battery electric vehicles, EVs.
Right, no catalytic converters needed.
Exactly. EVs don't use PGMs for emissions, so widespread EV adoption would definitely hit long-term palladium demand hard.
But there's an opportunity side, too.
There is. On the flip side, platinum is actually critical for the growing hydrogen economy. It's used in PEM fuel cells,
Right.
in electrolyzers.
Oh.
So if hydrogen really takes off as a clean energy source, platinum demand could get a serious boost. We've certainly seen a lot of price volatility. Palladium's down quite a bit from its 2022 highs, while platinum forecasts are more modest increases. It's a very dynamic market.
And what about competition, especially in South Africa, since that's where Waterberg is?
Yeah, South Africa's Bushveld complex is, globally, it's the richest source of PGMs. So it's an incredibly competitive place to be. PLG's direct competitors are these established giants, Anglo-American Platinum, Impala Platinum, Sibanye, Stillwater. These are multi-billion-dollar companies operating for decades. PLG is definitely, like you said, a minnow swimming among whales.
A minnow with a potentially big pond, though?
Potentially, yes. But what's really interesting, almost a paradox, is that Impala Platinum, or Implants, they're actually a joint venture partner in Waterberg. They own about 14.86%.
Wait, so they're a partner and a competitor?
Exactly. It creates this really complex dynamic for PLG's management. Implants has a stake in Waterberg succeeding, obviously, but they also have a huge strategic interest in managing the overall PGM supply to the market.
Ah, so they might influence the pace.
Potentially, yeah.
Yeah.
It could influence their approach to how fast Waterberg gets developed, how the financing comes together. It's a really fine line PLG's management has to walk there.
Wow. Okay. And regulations. Canada, the U.S., but especially South Africa. That seems like a constant challenge.
Oh, absolutely. South Africa's regulatory environment is incredibly complex, and it keeps changing. You've got the standard mining laws, environmental regs, sure. But then there's the critical Black economic empowerment framework, the BEE requirements.
Right, the ownership rules.
Yeah, designed to address historical inequalities. It means ensuring certain ownership and management levels are held by historically disadvantaged South Africans. It adds this whole layer of complexity, partnership needs. Then there's the government push for local beneficiation, processing the raw materials inside South Africa. That could be costly, technically challenging for a new project.
Which explains the Saudi smelter idea.
Precisely. That's why PLG is strategically studying building a smelter in Saudi Arabia. It's actually a remarkably clever move. It gives them an alternative, a secure route to market, and helps mitigate some of those specific South African risks like Eskom's energy problems or potential labor strikes.
That makes sense. Now, those huge barriers to entry for new mining projects, normally a bad thing, but how does that actually play into PLG's advantage, given they're still trying to get this thing built?
Yeah, it's a crucial point, and it feels counterintuitive, right? But those massive barriers, they actually work as a strength for PLG. Why? Because they already have the Waterberg deposit, and they've already advanced it quite far.
Ah, they're already over some hurdles.
Exactly. Think about geological scarcity. Finding another deposit like this is incredibly rare. Then the sheer capital needed billions, the technical expertise, the regulatory and permitting hurdles that can take years, even decades.
Right.
So if you've already cleared a lot of those initial barriers, like PLG has, it gives you this huge competitive edge against anyone trying to start from scratch today.
Okay, so for a company like this, pre-revenue competitive advantage isn't about brand or market share. What is their moat then? What protects them?
Their primary potential advantage, it really lies squarely in Waterberg's unique geology. We talked about the shallow depth, the bulk minability. Their 2024 feasibility study confirms it allows for potentially very low-cost production.
Right, being the low-cost producer.
That's the goal. Being profitable even when PGM prices are low is a massive differentiator. And beyond the ore body itself, which is unique, it's more palladium-rich than the older platinum-dominant mines, they also have this thing called Lion Battery Technologies, Inc.
Ah, yeah, the battery venture.
Right, it's a joint venture with Anglo-American Platinum. They're exploring using PGMs in advanced lithium-ion, lithium-sulfur batteries. It's a forward-looking bet, kind of like venture capital, trying to create future demand, diversify away from just cars.
Interesting. And the ownership structure of Waterberg itself.
Right, it's a joint venture. PLG has about 37% direct interest, but effectively around 50% control as the operator.
Okay.
Then you've got partners like Nambo Withu, the BEE partner, HJ Platinum Metals representing Japanese interests, and of course, Implants.
So shared risk, but also complexity.
As credibility shares the risk, absolutely.
Yeah.
But it also means, fundamentally, PLG is pretty much a single asset, single country play right now. That concentrates the risk profile significantly. All their eggs are effectively in this one Waterberg basket.
Okay, that's a great overview of the business. Let's shift focus now to Chapter 2, Management Evaluation. How do you even start assessing leadership when there's no profit, no revenue in the traditional sense?
Yeah, it's different. You really have to focus on their ability to navigate what is just a long, tough, and incredibly capital-hungry journey. And look, over 2 decades, they have shown persistence. They've made progress against some pretty big headwinds, consistently getting those definitive feasibility study updates done, advancing the project stage by stage.
And handling crises. Their main crisis seems to be running out of cash.
That's basically it, yeah.
Yeah.
Their primary recurring crisis is the funding gap. Management's consistent response. Tapping the capital markets, whether it was that $50 million at the market program in late 2024 or the private placement in May 2025.
Or more dilution.
More dilution, exactly. But arguably necessary, to bridge that funding gap and keep the lights on, keep the project moving. They've also been pretty transparent, I'd say. Timely filings with the SEC and CDR plus SEDIA, and they're direct about challenges like that going concern note from the auditors we'll talk about. And they do have a public code of business conduct and ethics, for what that's worth.
So how do they decide where the money goes? When you're pre-revenue, burning cash, how is capital allocated? What are the strategic spends?
Well, the allocation is absolutely laser-focused. It's all about de-risking and advancing Waterberg towards production. I mean, look at the numbers. About $1 million spent on the project in the 6 months ending Feb 2025. Cumulatively, it's over $90 million since they started.
Wow.
And the key strategic initiatives really stand out. First, that Saudi smelter initiative we mentioned, cooperating with Ackland and Bros Holding, studying that PGM smelter in Saudi Arabia, a $4 million study, split 50.50. That's a particularly smart move.
The geopolitical hedge.
Exactly. It's a hedge against South African risks, energy, labor, regulations, you name it. Then there's Lion Battery Technologies. As we said, it's that venture capital style bet on future battery tech, trying to create new demand for their metals down the line.
And things like share buybacks, dividends, just not even on the table, right?
Oh, absolutely not applicable. Not even close. PLG is fundamentally on what I call the dilution treadmill. They have to consistently issue new shares to fund operations, to fund project development. It's a necessary feature at this stage. The real management skill here is raising that needed capital on the best possible terms, trying to minimize the hit to existing shareholders.
Okay, so if profits are non-existent, how do we think about return on invested capital, ROIC? Is that just meaningless here?
Historically, yeah, pretty much meaningless or negative. There are no returns yet. So instead, what you have to scrutinize is the projected return of the Waterberg mine itself.
From the feasibility studies.
Exactly. Using metrics like the internal rate of return IRR, the net present value, NPV, all derived from those DFS updates. The core question for you as an investor really boils down to this. Is that future projected ROIC from Waterberg high enough, compelling enough to make up for years of burning cash and the dilution you will face as a shareholder? It's all about the future potential.
Got it. A forward-looking calculation. Okay, let's shift gears again and dive into Chapter 3. Financial analysis. Let's talk numbers. Starting with that market cap, roughly $155.7 million as of our analysis date.
Yeah, and that figure, it firmly plants them in the small cap world, which, yes, can mean higher growth potential if the project works out. But it also signals significantly higher volatility and just inherently more risk compared to bigger established players.
And those traditional financial metrics, revenue growth, profit margins, free cash flow, for PLG, these just don't really apply like they would for, say, Apple, right?
Not at all. You're absolutely right. There's no revenue history to speak of. Profit margins, undefined or negative. The key number on the bottom line for PLG is the net loss.
How bad is that?
Well, it was $2.25 million for the 6 months ending February 2025 and $4.61 million for the full fiscal year 2024. They consistently show negative free cash flow. And that's precisely why they have to keep issuing new shares to cover that outflow. It perfectly illustrates that dilution treadmill dynamic. It's fundamental to their current situation.
But you mentioned a red flag earlier, something every investor really needs to know about.
Yes. Their auditors, PwC, explicitly included a note about substantial doubt about the company's ability to continue as a going concern in their financial filings.
That sounds serious.
It is serious. This isn't just standard legal boilerplate. It's a formal, stark warning from the auditors. It really underscores that financing risk for PLG is truly existential.
Yeah.
It highlights their complete and utter dependence on the capital markets just to keep going. It's the ultimate financial tightrope.
Okay, wow. Let's quickly touch on other stability metrics. Debt to equity is 0.96x, current ratio is 2.62x. What does that tell us?
Well, the debt to equity at 0.96 means liabilities are almost equal to equity. Though it's important that most of these liabilities are non-interest bearing, things like accounts payable. The current ratio, 2.62x, that's actually quite healthy.
Right.
I mean, they have enough liquid assets on hand to cover their short-term bills. That's a sign of decent short-term cash management, which is good. And just to reiterate, no dividends. All cash goes straight back into the project.
Right. Now, valuation. We know PE ratios are useless here. So for the listener, what is the right way to value PLG, and what does that method tell us?
Yeah, traditional multiples, price to earnings, price to sales, they're completely meaningless for PLG. Why? Because the value is entirely locked up in future potential earnings, not current ones.
So you have to look forward.
You have to look forward. And the most appropriate, most widely accepted method for this kind of company is a discounted cash flow model, a DCF.
Okay, explain DCF quickly.
Sure. Basically, you project all the future cash flows you expect the Waterberg mine to generate once it's actually up and running over its entire lifespan. Then you discount those future cash flows back to their value today using a discount rate that reflects the project's riskiness. That gives you the net present value, or NPV.
And what did your educational model show?
Our own educational DCF model, which is based heavily on the detailed 2024 definitive feasibility study update they published, it spits out an estimated intrinsic value range of somewhere between $2.50 and $4.50 per share.
Okay, that's quite a bit higher than the current $1.48.
It is a significant premium.
Right.
But, and this is a huge but, you have to understand how incredibly sensitive these DCF models are to the assumptions you feed them.
What are the key assumptions?
Things like the long-term prices for palladium and platinum, even small changes there, can drastically swing the NPV. The discount rate you choose, higher risk, means a higher rate, which lowers the present value. The initial capital cost to build mine, if that balloons, the value drops. And critically, the life of mine all-in sustaining costs, the AISC basically, the true cost to produce each ounce of metal year after year.
So lots of variables.
Huge variables. The current stock price, that $1.48, is really reflecting the market's assessment of the probability of the mine succeeding, weighted against all those risks and variables. It's pricing in the option value more than a tangible asset value right now.
That makes sense. We've covered the business, the management, the financials. Let's pivot now to Chapter 4, Market Sentiment. What are analysts? What's the broader market telling us about PLG at the moment?
Well, analyst coverage itself is pretty limited, which isn't surprising for a smaller development stage company like this. But the coverage that is there, it's largely positive, actually.
Oh, interesting.
Yeah, we see one specific buy rating with a $1.75 price target. Fintel's consensus target, averaging the few analysts who cover it, is $2.14. And the range there goes from $1.17 up to $3.28.
So all significantly above the current price.
All significantly above $1.48. Yeah.
Yeah.
Generally, that indicates a belief in the long-term story, in the project's potential, though we should mention Nedbank did recently downgrade them to underweight, so it's not universally bullish.
Okay. And recent news, how has that impacted things?
It reflects sort of cautious progress, I'd say.
Yeah.
On the positive side, you had that private placement recently, which helped their cash balance for a bit. The strategic Saudi smelter study announcement was seen positively. Good results from their AGM.
And the negatives?
Mostly broader sector-wide trends. You know, if precious metals in general have a bad day or week due to economic worries, PLG often gets dragged down too, regardless of company-specific news. Headlines like, "Precious metal sector laggards," don't help.
What about short interest? Are people betting against it heavily?
Not really, no. Short interest is relatively low, around 3.91% of the float. That suggests there isn't a big coordinated effort to short the stock down, but the technical indicators, they look pretty bearish.
How so?
The current share price, $1.48 US, it's below both its 50-day moving average and its 200-day moving average, looking at the Canadian dollar chart, which often shows cleaner trends for these dual-listed stocks. Both are generally seen as bearish technical signals, suggesting the stock is in a persistent long-term downtrend right now.
So there's a disconnect.
Exactly. That's what's genuinely fascinating here. The fundamental story, especially when you look at the analyst targets and the projected economics of Waterberg, it still looks compelling on paper, but the technical picture is weak. It signals the market is largely just waiting.
Waiting for what?
Waiting for a major concrete catalyst. Something like securing that massive multi-billion-dollar financing package. Until then, it seems like the market's content to just wait and see.
That's a really insightful point about the market needing a catalyst. Okay, let's move on to Chapter 5, ownership structure. Who actually owns PLG, and what does that tell us?
Well, institutionally, there are 48 owners holding about 14.12% of the shares. The key players here include Franklin Resources, Inc. They're the largest institutional holder by a fair bit, with over 10.4 million shares.
Franklin Templeton, basically. That's a big name.
A very big name, yes. Other notable holders include BCJ Capital Management, Manufacturers Life, and UBS Group AG, which actually significantly increased its position recently. Having a global asset management giant like Franklin Resources involved is a pretty significant vote of confidence. It suggests they see real long-term strategic value here. That's somewhat reassuring for smaller investors.
And what about insiders? Are they buying or selling?
Looking at the last 12 months, there have been basically zero open market purchases or sales by insiders.
How do you interpret that?
Typically, you interpret that as insiders not rushing to cash out. It suggests they're content to hold for the long term, not signaling any lack of confidence in the company's future prospects.
Okay. And ownership concentration.
It's highly concentrated. Hoskin Consolidated Investments Limited, HCI, which is a major South African investment firm, they aim to maintain roughly a 26% stake.
Wow, over a quarter.
Yeah. This concentration means the strategic decisions made by a very small number of large, sophisticated shareholders can have a really outsized influence on the company's direction. For you, the retail investor, what this means is you're investing alongside some very large, very sophisticated, and generally quite patient capital. Their continued support. You could argue that's one of the most compelling bullish factors for PLG right now.
Good point. Okay, now for the really tough part. Chapter 6, risk assessment. We know it's high risk, high reward. But the biggest risks here, they aren't really about whether the metal exists, right?
Precisely. The metal is there. That's pretty well established. The entire investment thesis hinges on whether management can successfully navigate these just immense economic, political, and operational hurdles to actually get it out of the ground and sell it profitably.
So let's break this down using a quick SWOT analysis. Strengths first. What are the core company strengths?
Okay, strengths. Number one, undeniably, is the world-class mineral asset itself, Waterberg. Tied to that is the potential for low-cost production because of that favorable geology. They also benefit from strong strategic partnerships with big names like Implats, Jochemek, Hanwha. And finally, they do have an experienced management team that's shown persistence over a long time on this specific project.
Okay. But where are the internal weaknesses that could trip them up?
The core weaknesses stem directly from their current stage. First, the pre-revenue status and continuous cash burn. That leads directly to the existential financing risk, which we saw highlighted by the auditor's going concern warning. There's also significant single asset concentration risk. Everything depends on Waterberg. And finally, for investors, there's the inevitable shareholder dilution that comes with constantly needing to raise capital. It's just part of the deal right now.
Makes sense. What about the big opportunities out there in the market? What could really propel them forward?
Key opportunities include potentially favorable PGM market fundamentals, especially that structural platinum deficit we talked about. Their strategic de-risking via the Saudi smelter study is a significant opportunity to secure their road to market. The high upside bet on battery technology through Li-ion battery offers potential future demand. And there's also the possibility of increased platinum substitution in the auto industry, as platinum is currently cheaper than palladium.
And the flip side, the external threats that probably keep management up at night.
Oh, there are plenty. Primary threats include commodity price volatility. A sharp collapse in PGM prices, like we saw with palladium, would be devastating. Accelerated EV adoption remains a major long-term threat to palladium demand specifically. Then there's the significant South African jurisdictional risk.
Break that down a bit.
Sure, that includes political instability, changes in mining laws, the ongoing Eskom energy crisis causing power shortages, and the potential for labor unrest disrupting operations. And looming over everything is the ultimate threat: failure to secure mine financing, not getting those billions needed to actually build Waterberg. And don't forget broader macroeconomic factors. High inflation drives up their potential building costs, CapEx, and operating costs, OpEx. Rising interest rates make any future debt more expensive and also increase the discount rate used in valuations, lowering the project's NPV on paper. Geopolitically, things like trade wars or tariffs could hurt global growth, vehicle sales, though PLG's partnerships in Japan and potentially Saudi Arabia do offer some diversification there.
So, connecting all those risks, what are the key things management is actively focused on mitigating right now?
They're juggling several key risk areas. First, financial risk, trying to mitigate the failure to secure financing by advancing the project, seeking potential buyers for the metal offtake agreements, leveraging those strategic partners, and maybe looking at phased development options. Second, market risk. Aiming to be a low-cost producer helps weather price storms and lion batteries in an attempt to create new demand streams. Third, operational risk from South Africa's infrastructure and labor scene. The Saudi smelter study is a direct mitigation plus ongoing community relations efforts. Fourth, technological risk from EVs. They're mitigating this by focusing on platinum's potential role in hydrogen and lion batteries' pivot towards the EV supply chain itself. And finally, political risk in South Africa, managed through government relations and emphasizing their strong local BEE partnership.
Okay, that's a lot to manage. We've covered a huge amount of ground. Let's bring it all together now in Chapter 7. Conclusion. What does this all mean for you, the listener? Let's start with the bullish points. The case for PLG.
All right, the bull case. It really rests on several strong pillars. You've got a genuine world-class asset in Waterberg, with clear potential for industry-leading low-cost production. This gives significant leverage to strategic metals essential for cars today, potentially hydrogen tomorrow, especially with platinum in deficit. They have the backing of sophisticated and patient capital Franklin Resources, HCI. Management is showing an intelligent de-risking strategy with things like the Saudi smelter plan. Lion Battery provides that high-upside call option on future tech. And maybe most compellingly right now, there's that clear valuation discrepancy. The current price is well below analyst targets and what DCF models suggest as intrinsic value.
A compelling list. But now, the equally compelling bear case. Why might investors stay away?
The bear case is just as stark. Number one is that existential financial risk, underlined by the auditor's warning and their constant cash burn. There's significant single point of failure risk tied to Waterberg in South Africa. The financing hurdle itself is immense. Raising billions is a monumental task with no guarantee of success. The long-term EV threat hangs over palladium demand. For shareholders, there's the guaranteed shareholder dilution as they inevitably issue more shares. And finally, the stock's weak technical posture, stuck in a downtrend, signals significant market skepticism right now.
And let's just restate that valuation point. Our educational DCF model suggested an intrinsic value range of $2.50 to $4.50 per share, significantly above the current $1.48.
Yeah, but that discount exists for very real reasons. It reflects all those significant risks we just listed, plus the very long timeline involved before any potential payoff. For the share price to actually bridge that gap, management has to execute flawlessly on a whole series of incredibly challenging milestones.
Like what?
Navigating complex geopolitics, keeping all those JV partners aligned and supportive, actually securing the multi-billion-dollar financing package. And all of this has to happen, ideally, within a reasonably favorable commodity price environment. It's a tall order.
So ultimately, an investment in Platinum Group Metals Ltd. It's really the definition of a high-risk, high-reward play, isn't it? It's fundamentally a bet on the future, with almost zero safety net from current operations.
Absolutely.
So the real question for you, the listener, is this. How do you personally weigh that immense future potential against that equally immense, undeniable risk? And perhaps more importantly, what level of conviction do you have in this management team's ability to actually turn that world-class hole in the ground into a profitable producing mine? If you found this deep dive helpful today, please be sure to like and subscribe to the Stock Analytics AI YouTube channel.
Yep, helps us out a lot.
And remember, for €4.99 a month, members get priority deep dives on specific tickers you request. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those analyses.
Or if you just want a one-off deep dive on a specific stock, you can always drop us a super thanks.
That's right. Now, the important disclaimer.
Yes, please remember this analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be considered financial advice. Always conduct your own thorough research, or better yet, consult with a qualified financial advisor before making any investment decisions.